Good evening and welcome to episode 44. Welcome to the bear market. Good evening to you, Wawi.
Good evening, Mark.
And thank you for tuning in. I hope everyone is doing just fine. It's been a crazy week in the stock market. Terrible sell-off day after day. And well, I hope everybody is staying put as we're going to try to discuss what's been happening in the market broadly and also specifically to the companies that have just reported their earnings, such as Wal-Mart and Target. And we're going to figure out what just occurred in recent days. So, this is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wawi Show. Just a disclosure before we proceed, this show is made for sharing information purposes only, not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with a passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. For those who have missed our 43rd episode, our previous episode, feel free to tune in later on after listening to this one. In that previous episode, we discussed the earnings of Shopify, Wayfair, SC, Lyft, DoorDash, Uber, eBay, and Airbnb. So it's been an earnings barrage in the past couple of weeks. And so far, these companies who have missed their earnings expectations have definitely suffered big time in their share price reaction. So now we're going to look at our weekly sentiments. We take a look at this every week. So for this week, the sentiment just got published by American Association of Individual Investors. As of yesterday, bullish sentiments have climbed to 26% from last week's 24.3%. So these are the investors that think that the stock market will be up in the next 6 months. Meanwhile, bearish sentiments have increased as well from 49% to 50.4%. So neutral, or those people who are still 50-50, have kind of separated their ways, and some went to the bullish, more went to the bearish sentiment. So people are still overly bearish at this point in time. Not so much as compared to last month. Last month, we were in the teens, 16.4% to be exact. So people are turning a little bit more bullish at this point in time. Fear and greed index. So right now we are at extreme fear. So we're at 12 points compared to 9 points a week ago, or 6 points a week ago. So we're slowly, getting a little bit more bullish, but overall, people are still in the fear or extreme fear gauge. Market momentum. These are the movements of the stock price in the S&P 500 index, which is consists of the 500 largest companies in the USA. So market momentum, we're at extreme fear. Put and call options. So the tail that wags the dog. People buy put to cover their investments, or if they're betting that the market will go down, call if it's going to go up. So right now we are at extreme fear. We are at the highs, if not at least in the highest of the year, averaging between January and April. So the market volatility, believe it or not, for the past week, we've been, climbing up and down, but overall, the volatility is almost at neutral. We're going to look at the volatility index and the VXN index, which, tracks the S&P 500 and NASDAQ respectively, how they have reacted to the up and down gyrations of the market so far in the past 5 days. So another shot of the put call ratio. We're definitely at the highs, not seen since May 2021. So people are at least trying to be on the put side, or trying to protect their portfolios in reflecting being more bearish. So volatility index, that's just what we have said seconds ago. We are actually down 3.8% in the past 5 days, regardless of the sell-off that we just experienced. That's for the S&P 500. For the volatility of the NASDAQ, it's down 12.5%. So it doesn't mean that you're going to bet at volatility increasing or the up and down in the NASDAQ for the past 5 days. You're going to earn money. No, you actually lost money within the past 5 days if you've bet that the Nasdaq will be volatile. In fact, it's down 12.5%, which is interesting because for the past week, I know that we've been just going downhill, right? Well, correct me if I'm wrong, but I know we've been going downhill.
Yeah, for the past what, 4 weeks?
Mhm.
Going 5 weeks now?
Yes.
Yeah.
So now we're gonna look at the year to date. So since January, for the Nasdaq, we're down 27% since the start of the year. S&P 500 we're down 18%. Dow Jones we're down 14%. So nobody is in the green if they're betting in the index since start of the year. For the past week, we're looking at, wow, interestingly, energy. Well, obviously, energy's always been up since the start of the year, right?
Mhm.
Basic materials, utilities, healthcare is up. Financials, amazingly, is up. It does look like every sector is up this week. It doesn't feel like it though, but it reflects here, except for obviously consumer defensive. So what are these consumer defensive stocks? Would you be able to pull it up on the side while we go through the chart here?
Let's see what I can
Like
pull up.
let's see the largest ETF on the consumer defensive side, and let's take a look at the top 10 companies in that ETF. But yeah, the consumer defensive is down primarily because the earnings report that Walmart came up with and Target came up with later on. Now, which we're gonna focus in a little on this episode, how well did they do, and what are the facts or information that we can derive from their report, so as to help us gauge whether we're still in our right mind to stay invested in the stock market at this point in time. Uh, Year to date, obviously, we just mentioned energy is the top performing sector, 33.29% positive returns, while the rest, all other industries, are down in the red. Consumer cyclical is the biggest loser, followed by technology, at almost losing 30% for technology, 28.9% down. Now we're looking at Chicago National Federal Reserve Financial Conditions Index. So this index tracks the tightness of the money supply. So word per word, it provides a comprehensive weekly update of U.S. financial conditions in money markets, debt and equity markets, and traditional and shadow banking system. So we are slowly climbing up as me and Huawei have slowly tracked this index since July of last year. So we're climbing up, not seen since July of 2020. So if this inflation and increasing rates continue on, money is going to be tight for a lot of people, not only for the stock investors, but for the broader market. And we are slowly seeing signs of that, signs and symptoms in the medical field of that in the consumer. So, Wally, were you able to pull up the consumer discretionary people or stocks?
Well, ETF, I pulled out
Okay.
ticker RHS,
Uh huh.
FSTA. They're up slightly.
Mm-hmm.
So I think consumer defensive is just up slightly. Like for RHS, it's 0.03, and FSTA is up 0.02, and Vanguard Consumer Staples is up 0.02 today.
So in Vanguard Consumer, let's take a look at its portfolio. I have it. Is it the VCR?
That would be the VDC on my
VDC.
screen. Mhm.
I wonder what company is in the VDC portfolio. Are you able to pull them up?
Let me see.
All right. While Huawei's pulling that up, consumer sentiment. We're still looking at the consumer sentiment now. So these are preliminary results for this month, according to University of Michigan, which we also been tracking. So for May, we're looking at 59.1%. This is down 9% from April, just a month ago. People are still being bearish, at least in terms of their spending. And their
Okay.
expectations is even lower, 10%. So what do you have
Also,
for us while we the portfolio or
So in that portfolio, VDC has Procter and Gamble at
Uh-huh.
which is its higher proportion is 13% for Procter and
Oh.
Gamble,
Uh-huh.
Coca-Cola 9%, Pepsi Cola,
Mm.
Costco, Walmart, Altria, Philip Morris, Mondelez, Colgate, Palmolive, and Estee Lauder.
Wow,
Those are the
these are
top 10 holdings.
yeah, these are major companies, right, Huawei? These are major
Hmm.
consumer discretionary companies. So I would like to identify them as the stalwarts or that cannot be like just easily bothered, because
Hmm.
of a sell-off. But so far, we've seen in particular, or specifically Walmart crashing at least 12% in one day and followed by another 5% today, right?
Yes, yeah, yeah.
So
Out of that 10, Walmart uh, performed poorly this week.
mhm. Even Costco, I saw Costco falling like 13% yesterday in one day. So something's
Mhm.
up with the consumer discretionary or where typically people go to buy their groceries. So this is a warning sign in terms of like stability, price stability, investment stability in big major companies. So what we're seeing right now, Wowie, is I believe that like we're done. We're moving on from small caps, highly unprofitable companies, new startups, to the major, like big companies that are already entrenched and deeply reflect consumer sentiment. So, for listeners who just tuned in on this episode, me and Huawei have been identifying negative consumer sentiment since late last year, actually, right,
Mhm.
Huawei? When
Yep.
they think it started with the mortgage. I mean, buying houses because the forever higher prices. Consumer sentiment have slowly lowered down. And now in the preliminary results, we're looking at further negative readings for this month. So if this continues, I'm not predicting that we're gonna see lower stock market prices, which is being more uncomfortable recently because of the
Yeah.
continuous sell-off. But there's no
Yeah.
telling.
So
Mhm,
people are really more uncomfortable, Mark,
mhm.
because these are the safe havens, right?
Right, exactly.
So when
Consumers,
you're
consumer discretionary. Yeah.
yeah, so when you're trying to hedge um, your portfolio, you go to your safe haven during inflation,
Hmm.
and usually these are inflation proof. But
Right.
Walmart has been affected, and Target has been affected by higher
Right.
costs.
Right. Higher costs, which we're gonna definitely see in their numbers in a little bit once we dive into their quarterly report. So on June 15, next less than a month from now, the Federal Reserve are gonna be having their meeting. And what's interesting is Powell, I think he said that he's not gonna rule out 1% hike, but
Mhm.
people are thinking maybe he's going to do another half or 0.5% increase in rates. But if you're going to look at the CME predictor, which involves fund managers and experts' prediction, they're seeing 99.6 probability that Federal Reserve Chairman Jerome Powell would raise the interest by 1.25 to 1.5%. So that's even double or triple almost the projected rate hike. So definitely tighter monetary policy coming.
Mhm.
And if you're going to take a look at the screenshot from Bloomberg, the Federal Reserve to plow ahead on half point hikes, undeterred by stock slump. So despite the stock market selling off day after day, every other week since the start of the year, the central bankers view tighter financial conditions as actually helpful. This is in order to contain primarily the rampant inflation that we're
Mhm.
experiencing. So I hope they don't overdo it like what they did with the easing back in during the COVID lockdown days, where they started buying billions and billions of mortgage and lowered the interest rate to near zero. But yeah, definitely we're feeling the heat right now as stock investors. And now experts are looking at 1.25 or 1.5%. Oh my gosh, that's pretty high at this point in time. So,
Mhm.
consumers, borrowers are definitely showing some signs of weakness. This is a Wall Street Journal article screenshot. It said more subprime borrowers are missing loan payments. Borrowers with limited or troubled credit history are defaulting on their credit cards, car loans, and personal loans. So this is a warning shot. If you think banks would benefit from higher rates, also hope that banks are able to receive or able to receive the impact from these subprime borrowers defaulting. I know JP Morgan for a fact that they have set aside billions to counter this possible downdraft in poor performing loans. So nonetheless, this screenshot here again from Bloomberg, 11 trillion and counting.
Mm.
So we already lost $11 trillion. This is as of yesterday, not including today's. Today we kind of actually traded almost flat, but $11 trillion have been lost in
Mhm.
the stock market globally. So it's been quite an impact, and we're feeling it definitely, right, Maui?
Well, yeah, definitely. And a lot of it, it just equals that 11 trillion is equal to what the amount of mortgage-backed securities that the Fed had put in the market, right?
Not
During
hundred.
since
Yeah, I'm not
since the COVID.
100% confident on agreeing to that, but yeah, they did a lot of buying for sure. The question remains is have we lost all the gains already since the COVID? So I might as well pull up my quick chart here from Google Finance. That way we could see it. So if we're gonna take a look at the S&P 500, we're gonna take a look at its 5-year performance, and we're gonna see from COVID lockdown, we've gained until at least early part of this year 102%, 103%. So we gain about 2,300 points. And since its peak, we have lost 825 points. So not saying that we're going to lose probably around 1,500 more points, which would end up being lowering the whole S&P 500 down to 3,000. But, anything goes with this market right now.
Yeah, I
If
think they're putting the floor at 3,500,
mhm,
and
3,500 will be at least how many? At least 11% down from here. So another good amount of correction. But yeah,
mhm.
we're close to bear market for the S&P 500. Nasdaq is already at the bear market. If we're gonna take a look at this chart by Charles Schwab, Miss Lizanne Saunders, she had updated this as of yesterday. So if we're gonna take a look at the S&P 500, average member of the S&P 500 is down 28% from its 1-year high. It's more than a bear market for an average S&P 500 member. For Nasdaq, an average Nasdaq member, which is, mostly tech companies, they're down 50%, half from their 1-year high. Also, the Russell Index, which compromises the small stocks, small caps, is down 49%. So nobody has been spared. Everything is down since the start of the year. So this quite triggered me to look up like the global stock market. How is the global stock market indices reacting to this? So if we're gonna take a look at, we already discussed Dow, Nasdaq, S&P. We're just gonna cherry pick. For Europe or Eurozone, they're down 15.3% since the start of the year. If we're gonna look at Japan is down 8.3%. Spain, that's part of Europe, so we're going to skip that. How about Australia? Australia is down, or this is Greece. Sorry. Australia is down 5% since the start of the year. Oh, Bahrain. Bahrain is like the Middle East, right, Wowie? So
Mhm.
more oil for them. They're up actually 6.95%.
Mhm.
Above, this is Brazil. Brazil is actually up 2%. Taiwan, or this is Canada. Canada is down 5%. China or Shanghai is down 15%. So we're seeing more down in the US and also in Asia. Hong Kong is down 14%. Nifty. Jakarta. What is Jakarta? Jakarta is that Indonesia?
Indonesia. Indonesia.
They're up 3%, 3.6%.
Mhm. That's
So
where our palm oil is coming from.
commodities. So commodities is up probably
Mhm.
because of their economy. So that's one way to look at it. The sell-off is felt heavily in the US, parts of Europe, and more in Asia. So layoffs, this is a website that I just found this morning. I was just wondering, like, since Netflix is laying off a bunch, 150, and Amazon is thinking of chopping down its employees. Walmart also says that they're overhired. So we're slowly seeing a rise and new employees being laid off. But this
Mhm.
is, startup layoffs. So it doesn't include actually Walmart and stuff.
Well,
But
there's a slight uptick on job loss claims today.
yes, I did see that
Mhm.
too. So if we're going to take a look at the largest employers in the United States, number one is Walmart, 2.3 million
Mm.
employees. Number two is Amazon, 1.6 million. So these two, between them, that's almost 3.8 million. That's actually 3.8 million employees. So if they,
And with increased wages
uh-huh,
to their employees, that accounts for a lot of their cost.
a lot of costs, exactly. So they've been ramping up the costs last year because there was heavy demand. Because the stimulus checks flowing in, people buying, and they cannot get their orders, but still, prices are increasing. So does inflation.
Mhm.
So yeah, now layoffs are increasing, and then, like you said, there's an uptick in unemployment claims. So transportation feeling the heat, laying off, travel, food, finance, real estate. Those that are
Well,
less layoffs are in the legal, support, product, and security. Yes, Wawi.
services are up today
Mm-hmm.
on the market, so we're gonna see an increase in demand for services this summer.
Right.
So there should be less of those layoffs on services.
Yeah. One can hope. We'll see if the spending supports it, because consumers are definitely trying to save at this point in time. Um.
So that would be, looking at, hospitality, hotels, airline travels,
Mhm.
cruise
Speak.
lines. How are cruise lines doing? Let's check Carnival.
Mhm. So while you're checking Carnival, pulling up the personal savings rate. So this has climbed up tremendously since during the lockdown days, because people were being sent checks, stimulus checks, to pay
Well,
for
it's not
their
doing so
monthly.
good either.
Yeah, well, it says here, well, look at that sharp turn. So at one point we were actually at the 30s, 33.8% in April, when everybody's
Mhm.
hunkered up in their homes and not spending. Um, and now we're at 6.2. Levels not seen since, I would say, 2018.
Mm.
So, and like what we have discussed in our previous podcasts, people are getting more into debt. And it's not a good sign when subprime borrowers are starting to default on their loans.
Yep.
So, yeah, before we proceed to the S&P 500 ratio, were you able to pull up the
I was able to You mean Carnival?
Yeah, Carnival. How they're doing.
Yeah. Yeah, well, they're actually down 1.88% today,
Mhm.
and for the year, oh, let's see, they were at 28 start of the year, and they're down to like 12, I think, today.
So they haven't.
No, 13 today.
So that's quite a big drop. Fifteen
Hmm.
dollars down.
And we're supposed to expect, increased travel, but I guess there's still fear in getting in those ships.
Right. And also their debt burden. But that's for another topic. For now, we have the S&P 500 price to earnings ratio. So currently, May 19, we're actually at 19.71 times earnings.
We're
So,
below 20 now.
so we're below 20. And if we're going to look at its chart, this is a low that we have experienced pre-pandemic at
Mhm.
19.7 times. So
So we're back.
yeah, so I'm not saying it's a good time to buy, but definitely we have gone into a correction mode. The valuations have caught up at this point in time. So now we're going to jump on the companies. We're going to take a look at Walmart and its performance. So hang on tight because we're going to pull up its stock performance since the start of the year as well. Here we go. So for Walmart, it's down 17.68% since the start of the year, including a crazy drop just a couple of days ago when it reported its earnings. So Walmart ended up down 2.74% today at $119 a share. It's actually almost at its lowest for the past year. Its forward earnings ratio, price to earnings ratio, is 19 times. Its market
Mhm.
cap is $407.99 billion. So looking at its earnings, it actually missed its earnings expectation and it beat its revenue expectation. So kind of 50-50 there. And if we're going to take a look at its press release, which we have pulled up here, now we're going to slowly dive into its numbers. So hopefully our listeners stick with us as we're going to try to breeze through these numbers, do rough estimations, rough math. So let's see, scroll down, boom, boom, boom. Here we go. Revenue. So this is for the 3 months, for the first quarter of this year, ending in April 30. Net sales, total revenues, they increased 2.4%. So this, they beat Wall Street estimates. They raised their revenue by almost 3 billion. Meanwhile, their profit dropped by 25%. That's 25% drop or 700 million less for Walmart. So that kind of shocked their investors because they didn't meet Wall Street estimates, primarily because of their costs and expenses. So
Operating expenses.
yeah, their
Or
operating expenses climbed 3.5% for cost of sales, or nearly 3 billion, and almost a 29.4 minus 28.1, and 1.3 billion increase in administrative expenses. That's for their salary for their employees. So their
Mhm.
profits withered down by almost a quarter.
But they had to have those employees during, the holiday season when everyone was still getting, you know, money from the government, and it's
Mhm.
hard to get workers to come to work.
Could be. I agree. Meanwhile, their cash has dwindled too. They've from 22.8 billion last year, they're down to 11.8 billion. So nearly 11, well, almost 11 billion drop in cash levels. So meanwhile, their long-term debt have at least fall down by 8 billion. and short-term borrowings, probably long-term borrowings turn into short-term at this point in time. So they have altogether about 40. We have to include the operating lease. So that's 32 plus 13, that's 45 plus 3.6, 48.5 plus 11. That's a lot of debt. Almost 60 billion in debt with 11.8 billion in cash. So companies are a little bit experiencing a little bit more debt at this point in time. So that's what's up with the Walmart operations. Yeah, quite a drastic drop in their profit bottom line. That's shook the investors incredibly.
Yeah, they were not expecting that
Yeah.
from Walmart.
So now we're going to take a look at Target. So Target actually suffered a big, nasty drop. They're down 33.85% since the start of the year. And if I'm not mistaken, they dropped yesterday alone by 25%. So Target closed like today, it added more. It was down 5% today to 153.43. Over a day ago, it was trading more than $200 a share. So we're close to the 1-year lows at this point in time. Its forward earnings is 12.75 times compared to Walmart's 19 times. So it's a little cheaper than Walmart. More cheaper, actually, 12.75 times. Market value is $101 billion. So Target, let's see. Let's see what Target ended up delivering at this point in time. So Target actually missed earnings and beat revenue. So similar to Walmart. So what we're looking at right now is their report. Let's jump onto their numbers. Their sales actually rose by 4%. Comparison or compatible with what Walmart experienced. Their sales rose, at least for this quarter, to 24.8 billion. That's about almost $1 billion more from last year. While their profit, here's the catch, Huawei. Their profit dropped by more than half, 52%, 51.9%, from 2 billion last year down to 1 billion this year. And if we're gonna take a look at their expenses, their cost of sales increased by 10% right here. So nearly 2 billion rise cost of sales, while their salary, their administrative expenses, general and administrative, rose
Slightly.
just a little bit. Yeah, 200 million compared to Walmart. Walmart's over $1 billion. But still the company delivered or lost half of its profits compared to last year. So that's that's what caused the stock to drop crazily. Even until now, the sell-off is not done as of today. Their cash, oh my, they're dwindling in cash. From last year's 7.8 billion, they're down to 1.1 billion in cash. While their debt, they have a good amount of debt. 13.4 billion in non-recourse debt, borrowings, lease liabilities of 2.5. So that's 15.8, about 16 billion in rough estimates. And plus another billion for short term. So about 17.8 billion in debt compared to 1 billion in cash. So quite a good amount of debt right there. So before we jump onto the next, I would like to use this valuation tool or charting. I think there's a charting option here. So this would help us see whether at this point in time, if Target or Walmart is actually trading at a good discount compared to its history. So we're going to take a look at its price to earnings. We're looking at Target right now. Look at that, Huawei. Look at that big drop.
Ooh, it's just precipice.
Yeah. So we haven't
Drop from a
seen,
precipice.
seen this 12.67 ratio for target since this point in time, 2019, between 2019 and 2020. Meanwhile, let's see a Walmart. If we can pull up Walmart, how do we do that? So we haven't seen this low since 2019 for target price to earnings, while Walmart price to earnings ratio, it's down to 19 times. So if we're going to take a look at its 5-year historical average, also a sharp drop, but we haven't seen this low since early 2021. So definitely lower now, right now for those two.
Yeah, and I think Amazon started all these earnings
Mhm.
drawdown.
That could
So
be
it's just like a domino effect
right.
of these large retail companies.
Retail, yes, exactly. Because I was gonna say for large drawdowns, I would say it all started with the Netflix, the big company, one of the
Oh, okay.
yeah. But for
Mhm,
consumer, yeah, for sure, it probably
mhm.
all started with Amazon's flop on their earnings. So now we're looking at TJ Maxx or TJX, which owns TJ Maxx and other companies. So TJX is down. Well, I don't have TJX pulled up on the year-to-date performance. So we're gonna take a look at live data from Google since the start of the year. Let's see the information. It's down 18.72% since the start of the year. So TJ Maxx, let's look at the numbers. Let's see if they met the Wall Street estimates here. So TJ Maxx is up 2%, $61.40 a share. It's about 50%, nearly half of its range for the past year. So it hasn't experienced a huge sell-off like what Target and Walmart experienced. Its forward price to earnings, believe it or not, is close to Walmart's. It's at 18.95 times. Market
Mm.
value is 65.91 billion. So TJ Maxx, let's see. They beat their earnings estimates while missing their revenue estimates. So it's a counter
Mhm.
result compared to the previous. So their sales increased by $11.3 billion, which is strong. I'm sorry. They increased their revenue by 1.38 something billion. So that's pretty strong. If we're gonna do the math, that's 1.8 divided by 11.4, about 15%. Wow, pretty good. Pretty good growth in their revenue, while their profits increased by about 50 million. Because this is in thousands. So 87 minus 33, 54 million rise. So they grew their earnings and they grew their sales and earnings as well. Their cash also dwindled from 8.7 billion last year. It's down to 4.3 billion. While their debt, wow, they're pretty situated nicely. They have good control. They have about, well, I'd take that back. They have operating lease liabilities. So 7 plus 3, that's 10, 11 billion in long-term debt plus 1.6, 12.5. So they're quite leveraged at this point in time if we're going to take a look at debt to cash ratios. But yeah, so TJX, not so bad, I would say.
Mhm. I agree.
Growing in both revenue and profits, regardless if they beat expectations or not. So
All
Ross,
you
huh?
are you gonna look at Ross? Yeah. So
Yeah, we
that's
got Ross stores.
mhm.
So far we have Walmart, Target, and TJX. So now we're looking at Ross. Ross is down 18% since the start of the year. So the Ross is also known for its discounts, on discount or department store
Yeah.
strategy. Or
Bargain hunting.
yeah. Or look at that. While we post market, it's down 23.54% as of this time. Oh my gosh. It's a sell-off. It dropped 23.5% as of this, because they just released their earnings
They,
about an hour ago, I think, as we were recording. We started recording. I saw news flash. So Ross Stores is down 24%. It's still moving right now, actually. It's down
Mhm.
to $70 a share, $70.75. Clearly, Seeking Alpha hasn't registered this because we're trading aftermarket right now. So we are seeing a new low as we speak. Oh my. So it's useless to say what the forward earnings ratio right now, because it's going to be
Mhm.
readjusted by tomorrow. So Ross Stores, they missed earnings and they missed sales. So if we're going to pull up, hopefully we're able to pull up, because it's just a freshly published information. Here we go. Let's rely on Seeking Alpha at this point in time. Hopefully they have there we go, the press release handy. Listeners, you're in for a treat. We're doing this live, so you're seeing what we're seeing, and this is how we take a look at numbers. And shortly after this, we're gonna take a look at Home Depot and Lowe's. So those are like another like home improvement companies, obviously, and we're gonna look at their sentiments or their reports as well.
Mhm.
And you know what? I forgot. We have to take a look at the inventories as well for these big companies. If inventories
Mhm.
are piling up, so that's
Yep.
one thing to watch out for.
Well, I noticed when you were pulling up Walmart that Walmart is up on their inventories.
Hmm. So that's one thing to worry about. If inventories are piling up, so sooner or later they have to probably discount them all, because if they're not like being bought
Mhm.
and people no longer need those items because of the
Yeah.
delay, then
Mhm.
there's no demand for it. There's no demand, more supply, correction comes. And if that's the case, Huawei, I think actually in hindsight, that will be a good sign, meaning there will be less demand for a product. So therefore pricing can adjust,
Mhm.
and therefore that could slowly dampen down the inflation. So that might be a
That
good sign.
that
But
would be good for people. Yeah.
for consumers as well, and you know, that way the hype on the stock market. Now we've been experiencing a big drawdowns. So hopefully,
Mhm.
that's not a good, actually, like a good investment
Well,
plan. But
while you're pulling that up, what I notice on the grocery stores here is that their products, their produce that are, they're not perfect, right? And rather than throwing them in the trash bin, they're repackaging them and selling them. Like, you will see like a papaya with grapes and orange together, and they will sell them for like $2. And
still trying to eke some profit of
they're still
course of
trying to eke
investing.
some profit. And
Yeah.
yeah, so you're gonna see retailers doing something like that,
Yeah.
reducing their waste.
So hopefully we'll see how it goes. So now Ross, we have finally pulled up fresh from the oven. So from last year, they lost about 200 million in sales, which isn't that bad. It's not like dropping like crazy. While their total costs and expenses, it has remained subdued, believe it or
Mhm.
not. Ross is pretty good with their pretty disciplined. Actually, it died down a little bit. They were able to cut costs despite the rising wages. Their profits, though, have dived down from 476 million. It's down to 400. I mean, it's down to 338. So if we're gonna deduct that in rough estimation, that's 40% drop in profits, regardless
So,
of their ability to maintain their costs. So 40% loss.
so probably still affected by from their closures
And also
during
their
COVID season.
and also the 200 million loss in sales. So
Hmm.
something's up. People are not going to Ross stores that much in the first quarter, which means people are actually holding onto their money tightly. not spending, not looking bargains that much. Ross cash status is around $4 billion, while their debt is about 2.5 plus 2.5, about 5 billion. Not bad. 4 billion to 5 billion in debt. That's pretty good situation right there. But regardless, their stock price is on a sell-off. It's on a tear. It's like a Target Part 2 right here happening right now.
Well,
So
they had a 2-week closure, like I said,
mhm,
from March 20. Oh, well, sorry, that's an old news, but I know they had some closures
right,
that, but that shouldn't reflect the 200 million loss.
right.
But what I know is Ross is heavily shorted too.
Is it? Mhm.
Mhm.
Now the
So
shorts are cheering. They're gaining
yep.
the 25% drop after market. Next, we're gonna take a look at Home Depot. Home Depot is down 30, nearly 30% since the
Now
start of the
that's
year.
a Dow Jones stock.
Yeah, 29.58% down. So let's take a look at its numbers shortly. It's trading at $287.76 a share, close to its 1-year low at 281. Forward price to earnings is 17.28 times, which is a little cheap
Mm,
compared to Walmart. Market cap is $294 billion. So if we're
nice.
going to take a look at its performance as of a couple of days ago, it reported they beat earnings estimates and they beat revenue estimates. So Home Depot chugging along.
That's good.
So if we're going to pull up their report 2022, let's do this 2022. Okay, first quarter press release. So this was red hot, published a couple of days ago. We're gonna skip into its numbers. Oh, there we go. Nope. Where's the sales? There we go. So sales increased by nearly 4%, 3.8%, gain about 1 billion, 1.4 billion. Strong, 1.4 billion. And their profit, wow, they delivered 2.1% higher, about $100 million more. Meanwhile, their operating expenses, look at this, Huawei, even though their operating expenses increased by 3.7%,
Mhm.
or almost 300 million, they still delivered profits. So that's admirable. Their cash is sitting at $2.8 billion, while their debt is hovering. Wow, this company is overly leveraged, looks like. 39 billion in long-term debt. Yeah, 39 billion in the long-term debt with 2.8 billion. Regardless, it looks like it's a cash flowing company, but yeah, quite something to watch out for. But if we're gonna take a look at this inventory, so
Okay.
we're gonna highlight this for now.
Mhm.
25.3 billion in inventory compared to 19
Last year.
billion last year. And if we're gonna look at Walmart's inventory, I hope they do have it here. Yeah, looks like they have. Walmart inventory 61 billion, 61.2 billion in inventory compared to 46 billion last year. So that's a huge increase for inventory for Walmart. Let's look at Target. Target's inventory 15 billion from 10 billion last year, about $5 billion more of inventory. So inventory is building up broadly. This is TJX merchandise inventory, $1.4 billion more. Raw stores merchandise inventory, woo, $1 billion more. So inventories are building up. Like
Yes, yes. Mhm.
Walmart, would you look at that? That's
So
crazy.
that needs to move.
Yep. Move somewhere. 61 minus 46. $15 billion more in inventory for Walmart. Oh my. So maybe that's one thing that investors are afraid of. Let's look at Lowe's. Home Depot and Lowe's go hand in hand. So Lowe's is $187 a share, 187.86 dollars a share. It's close to his 1-year low at 179.85. Forward price to earnings is 13.66%. I mean, 66 times. So I'm looking at Home Depot. Home Depot is 17 times. So Lowe's is a little cheaper compared to Home Depot. Market value at $128 billion. So Lowe's, they beat their earnings estimate and they missed revenue estimates. So let's take a look at its report. For those who are still in tune with us, we appreciate you sharing this moment with us. I hope you guys appreciate that we're reviewing these numbers hand in hand, trying to see whether, this any signs from here bodes well for long-term investors like us. Yeah, I've been staying put with my investments and I haven't really sold anything, although I have lost a lot of paper wealth at this point in time. Very sad, but there's nothing you can do about it, I guess.
Well, same here, but I'm reshuffling.
Hmm.
I've been selling some of my earners and then buying some new potential growth companies.
Hmm. So you're still in the growth train
Always.
always. So
Well,
Lowe's. Mhm.
I
Oh,
do
go ahead.
have some value companies too, but there's some opportunities that I'm seeing in the market.
Right. So Lowe's, meanwhile, they actually lost or they missed revenue estimates. So from 24.4 billion, they're down to 23.65 billion. That's 4.22. That's about 550 million drop in sales. Meanwhile, their profit, they beat estimates, so 2.3 billion, not almost unchanged from last year. If we're gonna take a look at its expenses, it actually lowered by almost 200 million. So Lowe's is good at keeping its budget,
Mhm.
but they experienced slowdown in overall sales compared to Home Depot, where Home Depot actually ramp up their business almost 4%. Maybe that explains why Lowe's is selling cheaper compared to Home Depot.
It'll be interesting to find out which one of them have a better e-commerce solution
Mm,
or
mhm.
e-commerce traffic,
Yeah.
Lowe's or Home Depot.
Mm. Let's see if we can pull that up. But yeah, cash situation from 6.69 billion, they're down to 3.4 billion dollars. Their debt, meanwhile, let's see, 28.7 billion plus 639. So that's a good amount of debt, 29 billion in debt with 3.4 billion in cash. So online traffic, let's see if we can. Oh, you know what? Inventories. Inventories, we are seeing 20.2 billion compared to 18 billion last year. If we're going to take a
Okay.
look at Home Depot, 25.2 billion minus 19 billion. So I think Home Depot took in more inventory. That's 6.2 billion dollars more in inventory, while
Mhm.
Lowe's is about minus 18.38, 1.82 billion. Uh, but the size of
Well,
the company as well, yeah.
as far as their online sales as of their fourth quarter report, it grew by 6%. That's Home Depot.
Home Depot 6% online.
And by contrast, Lowe's
Mhm.
had a stronger e-commerce growth, um, 11.5% in Q4 and
Wow.
18.4% January of 2022. Now,
Okay.
this is what we're gonna see, right? They're gonna use a company called Gartner
Mhm.
to analyze their uh, this supply chain, their inventory versus, their e-commerce box business, and try to move it.
Right.
So, so maybe they're doing something here. They're since their e-commerce business is ramping up, that's probably why they're holding inventory. And with what we're seeing in the market, there's a demand for warehouses.
Mm-hmm. Could be one of the reasons
So,
why they could put their inventory.
and they're banking on selling. We'll
Right.
see.
So now we're gonna jump on to our last segment of the show. This is you know, our weekly. We haven't done this for the past couple episodes. The roll the clip segment. So this one is from an interview by CNBC of Scott Minerd of Guggenheim Partners. So this guy has been overly bearish since the last quarter of last year. Let's hear from him now that we are experiencing the sell-off.
Thank you so much, Scott, for being with us. My first question to you would be your initial reaction to this sell-off today.
Scott, I'm a little bit taken back with it because, I thought we were in the midst of a bear market bounce, and we know those can be pretty vicious to the upside. But, it is continuing the narrative that, I believe is unfolding, which is that given the aggressive posture of the Federal Reserve, we're going to be meaningfully lower this year in stocks before we find a bottom, because the Fed has made it clear that they do not have a put on the stock market.
Well, it may have a put on the bond market, which hasn't given it a reason to re-engage the put, I suppose. Look, you have a new note out today, and it's the impetus for us to have you on, where you discuss possible collision, that collision being between the cooling economy and a very aggressive Fed tightening, as you just said. Trying to avoid this collision really is the ultimate goal. Can we?
I don't think so, and I'll tell you why. I really believe that the Fed thinks that the neutral rate is much higher than it is. And of course, the neutral rate is the perfect nirvana short-term rate. And if you look at the research we've done, we would expect the neutral rate to be coming down pretty aggressively over the course of the summer. By the time we get to the mid part of the year, maybe into the third quarter, you would think that the appropriate policy rate would be somewhere in the area of 1.75%. Scott, they've made it clear to us that we're going to be at 1.75% by July. I mean, I think a 50 basis point hike has been advertised for the next two meetings, and they believe that the neutral rate is somewhere higher. So, I think at that point, the Fed will be an overkill. The weakness in the economy will dominate, and we could be setting ourselves up for a season of pain here, especially going into September and October.
This sounds to me like you think the Fed at this point is more aggressive than you initially thought it might be. And I say that because I remember our last conversation, Scott, in which you painted a picture in which you have almost a 2-year runway here before you go to recession. And stocks could go up in the first year of that runway until it gets real, until the Fed really steps on the gas and you have a recession come closer, and then obviously all bets are off. Has that view changed?
It has, absolutely. You got a great memory. I hand it to you. Look, I'm a great believer that you have to let the data tell you what's happening. And I had the opportunity to go to the central bank conference at the Hoover Institution a week ago Friday, and it was really interesting to hear these central bankers talking about how concerned they are about inflation, how high they think the neutral rate is, or how high they'll have to raise rates to get inflation under control. And, at the same time, not reflecting any concern whatsoever for the stock market. Remember that it was just 6 months ago or so that the Fed was telling us that rates were going to stay close to the zero bound for a protracted period of time. The aggressive pivot on the part of the Fed at least caught me by surprise. And, I think that given that they don't sense that there's a real level of panic in the market, and until we get something that is threatening to financial stability, they seem quite comfortable to watch the stock market go down, as long as in their mind it's an orderly decline.
So this guy had been bearish since last year, looking into a correction and possible, downdraft in the stock market. But now we're seeing one, and he thinks that the Federal Reserve doesn't have like a put on the market. So as long as the inflation fears are, hovering on around us, they're gonna keep what they're saying, keep increasing the rates, which can result into further sell-off. So it's a little bit quite troublesome. Looks like Huawei.
It's the inflation that is worrying the market. It's
Yeah.
the high cost of goods.
Yep.
And it's probably also reflective why inventories are going up.
Mhm.
They're trying to price their inventories where consumers will buy it.
Maybe hopefully, with these more supply on hand, and that kind of dampens some sort of price surge. So hopefully, except for oil, because obviously we're short on oil. I mean,
Mhm.
it's been reported on a weekly basis, week to week basis, that storage have been going down lower than the average. So, well, we'll see how it goes. Wowie. Yeah,
It's a balancing act.
yeah, the balancing act, but we'll see. It's gonna be a month from now since the Fed would provide their updates and rate hikes. So, and
Looking
it's gonna be
forward to
summer.
that.
Yeah, it's gonna be summertime, so people are probably gonna take a look at their portfolios and get shocked by how their portfolios have performed since the start of the year. So that's gonna be not probably baked in at this point in time in the stock market's performance. So
Right now, it's painful to look at.
yes. Well, while before we end, do you have any quote for the week?
No, just hang in there. And this is what happens when you're invested in the stock market and invested in these good companies.
Yeah, just ride the gyrations and stay liquid.
Mhm. Just
Well,
remember, this is the infrastructure of the American economy that makes everything work seamlessly.
that's
So
true.
just hang in there.
Yeah, it's a capitalist society. So this time, investors are looking for profitability and not just a simple story for growth. So, all right, guys. Well, that does it for this episode of Marky and Wowie Show. Check back on next week's episode. I hope you stay tuned. This is Mark Yu signing out.
Wawi Santos signing out.